Okay. And we are live on Facebook, LinkedIn, and YouTube. Good morning to you. Good morning for those of you who have joined us today. For those of you returning to our show, welcome back. For those of you who are joining us for the first time ever, thank you so much for coming on. And please give us some hands up or a thumbs up or something in the chat so we know you are new, so we can welcome you properly. I want to encourage all our viewers to like and share the channel or the platform that you are using to see us. And that way, every time we go live, every Thursday at 10 a.m., you'll be reminded to join us. And just a quick intro. My name is Marie Torossian. I'm a certified public accountant and a chartered global management accountant. I'm an experienced auditor and a CFO. As a transformation coach and a CPA advisor, I use my proprietary system called Valuation MT to help business owners in the service-based industry to grow from their first million to 10 million and more. I'm also an author and I've written a couple of books. I have an ebook, which is, I'm going to be putting the link down there. And you can go to guide.marieterrasancpa.com, and it's all about operational accounting. And my other book is on Kindle, and it's available on a digital format and a print format. And it's called A Business Owner's Guide. That one was a business owner's guide to operational accounting. The other one is a complete guide to business growth. With me today is, as always, my tax colleague, Pedro Gonzalez, CPA. He's always my featured guest, and he helps all my clients with their tax help. Pedro, the stage is yours.
Good
Introduce yourself.
morning. Happy New Year.
Happy
Our
New Year.
first episode of 2022. And
Yes,
I'm
that's true.
excited to be here. I truly something that brought us together, Marie, the passion to not only the numbers, to decipher the numbers, but also to share and help our clients. And so I'm excited, and I'm excited to see what we're going to be accomplishing in 2022. So Pedro Gonzalez, CPA, your business and tax strategist. We help, our main focus to help our clients achieve their financial goals by helping them with improving their cash flow, lower their taxes, and develop exit strategies. Like mentioned before, we all gonna exit. It depends on how. So the time is now to start looking your business planning, your tax planning, in order to achieve the goals that you are setting for yourself. We have an ebook for real estate guide or tax strategies. And so far, we've received some good feedback on that. I'm working on an S-Corp book geared toward the S-Corp in particular, about strategies for S-Corp owners. Once it's fully ready, we'll be sharing that too. And one of the topics that will be coming from that book, we're going to share a little excerpt of that. So get an idea of how, the differences. I mean, we share information here that you don't find anywhere else. We're willing to share good information, and in many cases reveal some strategies that you could, in essence, take it from here and implement it yourself. But the
Absolutely.
goal is so you can see what we could be doing for you beyond of what we're doing here. The information we share here is in general in nature. So imagine what we could do for you if we work together and design more specific strategies for your business.
Absolutely. Yes, yes, absolutely. I'm so excited about your upcoming book. I didn't know
Yeah.
you were working on it. That's awesome. I love that. I love that. And truly, I believe there's a majority of businesses, even when they are an LLC, they always choose to be taxed as an S corp. So I think that's a really great area that you are focusing
Yeah.
to write about. And there's a lot of intricacies because there's a pass through taxation, but it also, there's just some different intricacies that S corps go through. So I'm excited to today's
Yeah.
conversation is going to be very, very interesting.
Yeah. Yeah.
So the excerpt that we're going to talk about today from your book, that's going to be upcoming, is about what would be a reasonable compensation for a S-Corp shareholder, right? So, stage is yours, Pedro.
Yeah.
Tell us about this section.
Yeah, the reasonable compensation. Uh, that's a topic. It's nothing new. Now, it's taking
True.
some interest now, and that is because we're expecting the IRS to be targeting S corporation. That was the other motivation of the book.
Hmm.
Um, because S corps are going to be under the microscope
Got
in
it.
the next couple of years. One of the areas is going to be reasonable compensation. Now, the challenge is that reasonable compensation, while the IRS expects you to have reasonable compensation, they don't tell you what it is or how much. So the answer to how much is reasonable compensation is it depends.
Mm,
And so that's what the challenge is going to be. Now, there are a couple cases that give some light into what the mentality is of the IRS or how they're going to approach it. And so what we've been able to gather so far is that while they're not defining, you if you Google, some people are coming up with kind of the rule of thumb. I think some people say a third of your net profit. There's different formulas out there. Should it be based on your revenues? Should it be based on your net
hmm.
income before compensations, and on and on. So, but you should not rely on a formula based on a Google search, because that's not going to stand. If you're going to be
Yes.
challenged by the IRS, you have to have something uh, more meaty for them to
Right.
to sustain what your case. Now, keep in mind that if you have a business that is not generating profit, you're not expected to have compensation. I mean, that will be reasonable. That in that we're talking about development stage companies. You're getting
Understood. Yeah.
started, so that's why that number will vary. What I mean, that's why
Yes.
the reasonable and the answer will be depends. It depends on a couple factors. One, it's going to depend on the industry. It's going to depend on the location, the geographical location of your business. It's going to depend on the economics of the area where you're located. It's going to depend on your background.
Right.
What is your, for example, a CPA versus, let's say, an EA, the compensations will be expected to be different. A
Correct.
CPA in Florida versus a CPA, I don't know. And again, I mean, no disrespect to any other state, but let's say, for example, a CPA in Miami versus a CPA even here in, I don't know, Pensacola. You know,
Sure. Sure.
it's expected the compensations to be different.
Slightly different. Sure.
It is so the geographical locations, the economics of the location, the industry. So all of those will play a factor onto what they're going to look at to determine if you have a reasonable compensation. Now, the what is critical is at least you document. I mean, don't just pull a number and and go with it. I mean,
Hmm.
the best thing you can do is at least document it. Many associations, chambers of commerce, trade associations will have information that you can use that validates your basis for your reasonable compensation.
Got it.
What I mean? If you're an electrician, I'm sure that you go into some kind of trade association and they can
Sure.
tell you what a foreman or an owner of an electric contracting business should be based on either region or be on revenues. I'm sure that it is out there. I'm not saying that I'm sure, as I know it's out there. And
Right.
this is the basis of how we can extract information to tell you, is your compensation reasonable or not? So,
Right.
so one, again, if your business is under development stage or losses, you don't have to. Also, location, just kind of start recapping some of the points that we brought up. You have to look at location. Why do I bring that up? Because if you type right now the average income of let's say a CPA, it will
Nationwide
exactly. And
versus
so you
location.
might be overpaying yourself, which IRS
Sure.
is gonna complain about it, but you're killing yourself as far as taxation that you probably didn't have to do. Um, so, or you could be under because if you're in New York and you use the average, you're probably paying yourself lower.
Lower than, right, right.
So I will say go deeper than just the national average and look at your location where your
Right.
business is located. And I will not even use the statewide because again, even some states, if you're in a major city versus a more I don't know rural area in your state, the amounts also will vary.
True.
So look at the areas of your industry, look at your region. Uh, you can tap, like I said, to Chamber of Commerce and trade associations to pull. I know for us, for CPAs, we go to the AICPA. They put surveys and will
Hmm.
tell you what the compensation reasonable based on again areas, the size of your firm. Attorneys have associations that provide them
True.
information,
True.
doctors, you name it. So different trade association will provide you the information you need.
Right. And I know like certain other positions, let's say Robert Half and other recruiting firms also do their own research on an annual basis, and they do put out
Correct.
a lot of information out there that you can research based on the type of position it is, and then you'll be able to get it. I know they have one for accounting. They have different industries that they put out.
Correct. So now the other area is, and why this is going to become a hot button. The area of risk, what they are going to be targeting, typically is going to be those companies that are paying either very low or close to zero. What happens is that there's let's say for example, you have a business. Let's throw a basic number, 100,000 as
Hmm.
a sole
Yes.
proprietor. That taxpayer is expected to pay somewhere a little over $14,000 in taxes, self-employment tax alone, just on the profit of the 100,000. That taxpayer is expected to pay somewhere around a little over $14,000 in taxes. Now, you tell a taxpayer, which is one of the strategy we'll look. I mean, we're looking at this
Right.
taxpayer and saying, hey, you have a profitable business. Let's move you to an S-Corp.
Right.
Now, the S-Corp, what we could do is we're going to set a salary, and I'm going to throw numbers without looking at
Right.
analysis
Yeah.
of
Just for
credit, but let's say
examples.
50,000.
Yeah.
And the other 50, we're going to take it in distributions.
Hmm.
So the net result for this individual will be similar, you know what I mean? Because it will pay, but the difference is going to be that we're saving this taxpayer roughly half of that, so close to about $7,000 of tax saving just by moving this individual from a sole proprietor to an S corp. He's going to draw a salary of 50, and 50,000 is going to come in the form of distributions from the company. Now, assuming that the 50,000 reasonable compensation is all good.
Hmm.
Now, the temptation is that, well, why do I even pay myself a salary when I could take 100,000 in distribution, zero in
Hmm.
salary, pay zero in payroll taxes, and save $14,000 in taxes? That will be the temptation, but that is a huge mistake because you can put yourself at risk of underreporting.
Hmm.
And again, now that it's under the attention of the IRS, you probably become a target, especially if you're an active shareholder, because that's the other aspect that they're going to look at. Everything else that we have said so far, plus your participation in the business. It is unreasonable that if you're actively involved in the generation of revenue of your business, that your salary be zero.
Correct.
You know what I mean? So distributions, yes, is part of the compensation, but it should be your sole compensation. They're expecting you to draw a salary. That's what is customary, and that's what they're going to expect. And then they're going to compare you based on the industry, based on the economics. They're going to say, then now you're going to leave it on the hands of the IRS to determine what the reasonable compensation, because you didn't do it yourself. It's going to become now an uphill battle now for you to now disprove the IRS. They're going to hire experts in compensation to do it. That's why I suggest that you document it, do your due diligence,
True.
have a basis, and then at least I have something to battle with the IRS. They might disagree, and again, there has been cases where uh, the IRS won the case. It actually happens to be a CPA, but I think that the salary was substantial. I mean, I don't know why he would have done that, but the salary was like 24,000, and it's a profitable CPA. So again, that tells us that they're going to be looking at his areas of expertise. He was a CPA. He had an MBA. He had all this other training experience. Uh,
Sure.
and
Wow.
so, the salary did not make sense. There has been cases where the IRS kind of when didn't completely win, meaning that the tax court then what they did is did not agree with the calculation of the IRS. The taxpayer did have a calculation, and they went somewhere in between.
Mm,
You know what I mean? So the tax court established another salary, but at least the taxpayer had a basis for how they came up with this number.
right. They had
And the
something
reason,
that they could prove that this is
exactly.
what I came up with. Yes.
Exactly. At least I can tell
Right.
you how I came up with this instead of I just guessed it.
Right.
See,
Right.
that's the
Right.
risk because then it's almost like an intentional, potentially intentional act of underreporting.
Right. Right. We
Where the
definitely
other
want
one,
to
I can say,
remove any
well,
intentionality question coming up for them
exactly,
from the IRS. We want to make sure saying, okay, I did my research, I found this information, I found that, and I came up with this calculation based
correct,
on this and that.
correct.
At least it shows that you made an effort, right?
Exactly. And then now it might be that the tax court or even the IRS does not agree with you, but also you have a basis for negotiation. You know
Right.
what I mean?
Right.
The IRS say, Marie, I don't agree with you. And that's okay. But I can tell you how I arrived to my number.
Sure.
Now, the IRS is going to say, Marie, you say that your salary should be based on $20 an hour, which I don't agree. I think your salary should be more closer to $80 an hour. And you say, oh, I don't think so. And so, okay, so but let's talk about it. And then maybe you come up with, I don't know, $30 an hour. You, Marie, say, okay, I'll take the $30 an hour and I'll pay the taxes on that differential
The
of
difference.
$10.
Yes.
And
Right.
then,
Right.
okay,
Right.
so we're good. But if
Yeah.
you had nothing, how are you going to defend your
Your position.
livelihood?
Yeah.
Exactly.
Yeah.
Yeah. So
Document, 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 document.
document. Yes, and this
Think
is
like
gonna
an
be
attorney all the time.
yeah, and because of again, we're expecting this to be a hot button.
Yeah.
I
Yeah. Understood.
encourage anybody and everybody listening to this is to look at your compensation. If you don't know if it's reasonable or not, or how to determine that, I encourage you at least to start by contacting your CPA, at least have a conversation, and see if he or she can guide you into either them themselves helping you or guide you how to get this information. But it should not be disregarded, should not be ignored. I think at 2022, I would say start with that immediately. Look at your compensation because they will be looking at this.
This is definitely a very I can see how when you said this could be a really big hot button and it can really go to court and you're going to make a big impact for a business owner for something maybe could have been avoided completely by doing
Correct.
just a little bit of research, a little bit of
Correct.
a
Correct.
little spreadsheet with a few numbers on it, and it could really save them a lot of headache,
Yeah.
instead of going to court and everything.
Yeah.
So, would you be able to expand a little bit more on, let's say, I know you gave us some examples of like um, when we kind of put clients from and that are, let's say, an LLC or a single member LLC, and they move on to an S-Corp, that taxation and how they're actually saving money in a different way, right? So saving on taxes. Can we give them a little bit more detail on the taxability and the difference, maybe on the rate wise?
On what
The,
specific?
the taxes that they pay, let's say when they pay themselves a salary versus the taxes they're paying when they kind of getting the distribution out.
Well, the taxes is still going to be it's called self-employment tax. So that's why if going back to the example of the self-employed, the Schedule
Mhm.
C, just a simplest form, this individual has a business that generates a net profit of 100,
Right.
and this individual, this taxpayer, will end up paying a little over 14,000 in taxes, in self-employment tax plus income tax, because then that's depending on the rest of the because you can have an individual still with taxable income of zero and still has to pay the self-employment tax.
Right.
So that's why I wanted to keep it simple, because I wanted to highlight is the payroll tax. Now,
Hmm.
in S corp, what happens is the same individual with the same net profit, you
Hmm.
move him into an S corp now, and instead of paying himself or herself $100,000 in salary, you put is, let's say for example, 50,000. So you're in essence cutting that payroll tax in half, because the
True.
payroll tax will still be the same. I mean, you still have to pay the payroll tax, either
But the
because
rate at that 50,000 is going to be a lot smaller because they're going to
correct,
fall in a different bracket, a lower
because of the
bracket.
exactly the base subject to payroll tax. Now you
Yeah.
reduce it, and then the other 50 you're going to take in the form of distribution.
Right. At a different rate. So you're kind of like separating and getting taxed at different rates and different ways. So, there's going to be a net savings at the end.
Correct. Now the individual will have then a K1 now showing a $50,000 profit, fifty
Hmm.
thousand dollars above on W2, but the payroll tax has been reduced.
Right.
Yeah.
Right. It's being reduced from the business as a business
Correct.
expense.
Correct. And then that's something a lot of people don't see, because what happens is that this is almost like kind of in a way, kind of a hidden tax. A lot of times you see your 1040 and you see
Yes.
your tax that you're paying on your income, but you're not realizing that in addition to your income tax, you have to pay a payroll tax.
Yes.
And of course, depending on the tax brackets you're going to be for your uh, ordinary income, your for the income tax, that's also going to play a factor here. But again, that will be hard to determine, because the let's say that's that same scenario of the $50,000 in wages with $50,000 of K1, and you might end up having taxable income of zero through some other losses of other activities, and end up with a taxable income of zero. Then what happens then in that case is that you have no payroll taxes after that, meaning that all your payroll taxes were paid through your W2, but only half.
Hmm. Yeah.
And you're taxable, assuming that you end up on the same. And again, when we're doing this scenario, we're assuming that both in scenario you'll end up with the same taxable income. And in that case, if you had, let's say for example, for simplicity, taxable income of zero, then you have, the tax is zero. Your payroll tax will be then around 7 if you're an S corp. If you're a self-employed as Schedule C, then you're going to have taxable income of zero, but then you have self-employment tax of 14,000. So you did have to pay the tax. A lot of people don't kind of follow this, because what happens is not, a lot of the tax preparers don't go through the explanation, helping. What happens is they say, oh, what is my tax rate? My tax rate is zero.
Hmm.
My taxable income is zero. And so the person is all excited. Oh, great. But you still need to pay $14,000 of self-employment tax.
Hmm.
So where's the money? Yeah, so and it happens. So you see that still the business, your taxable income is zero, and the individual still need to pay 14,000, and they might already have spent it,
Right. Right. Right.
have the money now to pay it.
Right. Understood.
That's when they kind of hits them, is that there's this other tax that many times they don't get to talk about it. You hear a lot about income tax planning, but when we're looking at tax planning, we're looking at all of the different type
All
of.
of the pieces. Correct. Correct. Yes. I have something that I remembered in a situation where um, I was working on a project. This was quite a few years ago. And what happens when there's more than one shareholder, let's
Hmm.
say, and then let's say one shareholder is actively running the business, has is the one of the executives, but then there's
Yeah.
a secondary or third shareholder that does some things but is technically part of the board, but I just did that face.
I
Uh,
know, I know. I saw.
so because this was very confusing to me at the time because I couldn't really get a understanding of what the actual job of that
Yeah.
shareholder was, and there was a certain amount of things that apparently he was working on, like making connections and whatever, and so then he was getting paid for something, but he was also a shareholder, so he was part of the board, so there was like he was kind of active, but it was like a confusing thing. So what,
Yeah.
have you seen
No,
a
that's
situation
actually
like
a
that?
good.
Can we give like an example or something?
Yeah. No,
What
that's a
happens?
very.
What is a reasonable compensation for a shareholder like that? That's kind of
No,
active, but
that's awesome.
should not be
It is a
active.
good point that you're bringing up. Now,
Thank you.
yeah, no, it is, and then and that is gonna bring up another interesting element to the mix.
Okay.
Now, let's talk about, and again, to keep it simple, two individuals, they're shareholders 50-50
Yes.
in the ownership.
Sure.
One is heavily involved in the management of the business, one is not. And again,
Yeah.
let's keep it simple. Then what does that mean? It's somewhat involved, but not in the day-to-day operation. It's kind of
Right.
there. Now, I can tell you that the IRS will probably, one, you're not expected to take even a compensation because you're not actively involved.
Yeah.
Now, I can tell you the IRS will look at that kind of funny because they're going to
Yeah.
wonder, why are you even a shareholder on a business that you are not actively participating and you get no compensation?
Right.
Or if the compensation is very little, they're gonna again look at this kind of funny. I mean, your explanation, okay, I can see that you are hardly involved, but they still kind of question it.
Mm. Yeah.
So it depends, I guess. Again, what exactly is this individual doing now? If let's say, for example, you have, let's take a CPA firm. You have a younger CPA that is, let's say, with the plan of taking over the business. So he or she is the
Sure.
one really in the day to day. In essence, the practice manager is in they there, managing the
Yes.
employee. So he or she is the one driving the larger salary. Is actively
Yes.
involved. So
Yes.
she is also a shareholder. Now there is assumed that the exiting or planning to exit partner, she is basically now moving out of the day to day operation, and her role now is more about client relationship, bringing, she has been the kind of the face of the firm,
Yeah.
and she's grooming this newer CPA to take over. Now, it will be difficult to have zero compensation
True. True.
because you can say, well, but I'm not active. Active in the sense of, what does that mean? Active in what sense? I mean, that you're no longer doing the audits and the tax return preparation, but you are active in the practice development, in the business
True.
development.
True.
So you have to be careful when people say, well, I'm not active,
Yeah.
and we got to define what that means or what activity is. They're going to look at the whole overall business. Now, if you're staying at home, retired,
Yes.
and just kind of, they're kind of giving you an honorarium type of compensation because it's Marie Torossian, and we're gonna keep the name because she has
Name.
built
Yeah.
the
Yeah.
business,
Yeah.
and we're still gonna keep her face around because he has, in essence, branding.
True. True. That makes
So,
sense. Yeah.
uh, you know, we're kind of paying her, I don't know, $2,000 a month. She hardly, she might do write an article. She probably shows up at a speech or
An
something like that.
event
But
or yeah. Yeah.
exactly.
Yeah.
So
Minor
what
things.
exactly?
Yes.
Exactly. So it depends on what in this case Marie is doing. So if Marie is that's the case, she's now in essence truly retired, and she's just keeping the name. And she then in that case, I can see that either her compensation to be zero or to be very minimal. But if
Minimal. Right.
Marie is simply switching to another role and
Yeah.
she's active, not active in the grinding. She's active now is client relations, shaking hands and
Yeah,
closing deals. Now, I am not involved in the delivery of the product.
correct. It's
You're
just a
still
different title.
active
Yeah,
and you should have a compensation. Now, your role is no longer necessarily be looking at as a CPA, but a marketing director. So you
correct.
could be comparing yourself what, for example, marketing directors will be, or business
Right,
developers, or compensation should be based on percentage of closings or something like that. But
correct.
zero will be hard to justify.
Yeah, no, that totally makes sense. So then, when anyone in our audience, when you're trying to, build a partnership, or an S-Corp with another, you have two shareholders. I think it's the recommendation is that each of the shareholders figure out what their position is in the business, what their title is, what their tasks are, so that when they're coming up with their reasonable compensation, then they'll be able to say, okay, my compensation is based on the industry, let's say, of, this is the job, this is the title, this is what I'm doing, this is my location, this is what I get paid, and this is the other partner or the shareholder where this is what their job is, their title, and all that stuff. So then it's very clear to the IRS as to, where they stand, and their what their position is.
Yeah, yeah,
That's awesome.
yeah,
That's awesome. So I think this was exciting conversation.
yeah.
That's for sure. I love it. I can't wait to see your book, and it'll be very, very nice. And we'll share that information as well once the book is ready, and we'll put
Yeah.
the link up. And then that brings us towards the end of our session. It's 30 minutes. We want to be very cognizant of our audience's time as well. So 30 minutes, quick education, but very important, relevant education. And as always, we want to leave you with, who are the five people that you are surrounding yourself with that are helping you grow and support you. And we hope we are the two out of five that you are supporting yourself with. And if you need any additional help, we are always here for you.
Awesome.
With that, I'll say, have a wonderful week.
Okay. Take care.
Bye.